Now being recorded.
Hello, my name is Mike Emerson, partner with Indian River Consulting Group. At the beginning of April, we put together a cash flow modeling Excel workbook to help our clients and other distributors project the impact from a business and cash perspective of the evolving coronavirus pandemic. In the last week or so, we've gotten a lot of phone calls and people who want to talk about the implications of that tool, understand the functionality. So I thought I'd just spend a few minutes walking through the tool to provide an overview look at a couple scenarios. Now, we put this tool together and tried very much to optimize complexity and valuable information coming out of it. We could have engineered this thing to be much more complex, require a lot more data entry. We could have also made it much simpler. But if we made it too complex, then there'd probably be companies that the threshold might be too high, or in terms of available time to find it useful and put in all that information. But if we made it much more simpler, then the outcomes from the modeling would be less accurate. So we really tried to balance that. And what we'll see, we'll dive into in a second, is that we're asking for information that should be readily available off your income statement and a handful of accounts from your balance sheet to look at how the next year or so, based on revenue projections and other adjustments that might be worth considering, are going to impact your business and your cash. So with that, I will dive right into the model. What you'll see, and this is available on our website, available to download, is an Excel workbook with 6 tabs. The first tab is the instruction tab. Then we have kind of the 4 tabs that are where the data is entered and the modeling is done. And then we have a tab at the end titled FTE, which is more of a reference tab. And all of that is explained in the instructions. So the first thing I'd like to just strongly suggest is that the instructions are not too onerous. They're not incredibly technical. They do provide some decent background on some of the calculations and methodologies and definitions. So I would suggest that before using the template, the instructions are read. Secondly, before using the template, I would strongly recommend that a copy is downloaded, saved locally, and then as the modeling is done, each one is done on a new version, and not corrupting potentially any of the calculations in this one. Or if something does get corrupted or doesn't make sense, you can always go back and find it just as it was when you first downloaded it. Okay, so jumping right into the model, the first tab, this is really where most of the effort is going to be required from the user. We ask, and through all of this, right now, the model is populated. And when you download it, you will find that it's populated. So the first thing you'd want to do after you save it is go and delete everything that is in a shaded cell. Throughout the workbook, anything that's shaded means that it's a cell where a value can be entered. It's not formula derived. So all of these other cells here all have formulas in them, so you don't want to override those. But go ahead and clear out the numbers that are in here, and then we can start using it. What you see, very simply, is something that resembles an income statement that has sales, cost of goods, and your expenses. Okay. What we have is, starting in January 2020, sales broken down by stock and direct through the end of March. Okay. And the reason we break down stock and direct differently, and stock is something that would be brought into inventory, sold out of a warehouse. Something direct is going straight from the supplier to the customer, so it would not be coming into inventory. When we're looking at cash, how much inventory we have and how much inventory we need to replenish is material, right? So that's why we've broken these two out, as well as the cost of goods. Then we have 6 SG&A accounts, if you will. We've broken these out functionally. There's nothing that says that you can't change these to better map to your income statement. All we ask is that when we go down here and we look at total operating expenses or SG&A expenses, that they do resemble the SG&A expenses from your income statement. So we have used kind of typical PAR report categories: sales and marketing, delivery, warehouse, occupancy, IT, other general administrative. So relatively straightforward. Enter sales, enter cost of goods, broken out by direct versus stock. Enter in your expenses such that the total here resembles your actual income statement. And then the other piece to this tab is selecting the profile or the trend of expenses relative to sales. Okay, so we have expenses that are fixed. So if we sell 5 or we sell 50 or we sell 500, that expense isn't going to change. Okay, so we have a building and we have a fixed lease payment. So that is something that is not going to vary with sales. We also have variable expenses that trend perfectly with sales. So if there is a commission that's paid salespeople and they're 100% commission and they get X% of gross profit, then when gross profit doubles, then the expense doubles. So it's always going to be a relatively consistent percentage. Between those two, which is the profile of most expenses, is semi-variable. So they're going to have a fixed component that's not going to change, and they're going to have a variable component. So you've got trucks that have fixed leases, but the fuel and the labor that goes into delivery, driver pay, those are both variable, right? So we have offered here the option of selecting variable, fixed, or semi-variable. And semi-variable can be, mostly variable, 75% semi-variable, or very little variable, 25% variable. And what that means is, for example, if sales go up 10%, if it's semi-variable 75%, that means that the expense is going to increase 75% relative to sales. So if I'm spending $10 and my sales go from 100 to 110, then I'm going to go up to $10.75, right? So it's going to increase not 10%, but 75% of 10%. Same thing with 25, which is going to look a lot more like fixed expenses. It's going to go up 25 cents when my sales go up 10%. Okay, so enter in historical information, enter in the profile of how sales, expenses change relative to revenues, and that gets us set up to start building out some future scenarios. So after the historical income tab here, we have the pro forma P&L tab. Here is where we start looking at the future. And all that we do is build off the historical information that's entered, go ahead and enter in what potentially could happen over the next 12 months. Okay, starting in April, going through March of 2021. Okay, and enter in what revenue potentially could be relative to the same month prior year, right? So here we have a relatively subtle decline starting at 100%. So April tracks with April of last year. Then we start to see a decline, bottoms out July at 75% of July 2019. Then starts to climb back up, and we're kind of back in growth mode here towards the end of the year. So if you see that, if we plug those in and we build off of the historical expenses that have been previously entered, and we treat expenses as they've been indicated, whether they're variable or fixed, we can see what our net profit will be and how our expenses will behave. So with this trend, we've got a few months here where we don't make much money, but then we build it back. Okay, so this will give you an income statement view based on sales projections of what your net profit is going to be. And for the sake of our modeling, net profit is looked at as cash. There are, of course, non-cash items on an income statement or in your expenses like depreciation, but by and large, we don't make distinctions on that. So we enter in the historical information, we enter in some percentages here. We suggest that you want to look at kind of a realistic, what do you think is really going to happen? Enter those percentages here. What do you say? What's the worst thing that could happen, right? Realistically, if everything goes wrong, what do we think might potentially happen? So that's the scenario we're going to look at next. But in this case, things are relatively gentle. We have a few months where we lose some money, but we come back relatively strong. But the big question for distributors, because most distributors don't run into problems when they lose money, they run into problems when they run out of cash. So that's what we're going to bring into the equation here on the tab titled cash. And this basically has your four primary working capital accounts: cash on hand, accounts receivable, inventory, accounts payable. So those are the ones you're going to want to enter as of the balance at the end of February. Okay, and then it's going to project out based on sales and some simple logical algorithms. And so if we look at this, we start off with these balances in these working capital accounts, and then as our sales decline, remember we saw a decline, and then it picked back up, we start seeing our cash grow. And then we see as the business picks back up again, our cash shrinks. Okay, and this is a very common phenomenon, because when we're selling less, we're carrying a smaller receivable. So what happens is we don't have to have as much working capital in accounts receivable. So you see that declines here. We're also going to have less inventory if we're projecting our inventory properly. And this model assumes that we do a decent job forecasting. So when we replenish, we're going to replenish based on expected future demand, and not replenished on historical what we sold demand. All right, so we see our receivables are declining because we're selling less. We see our inventory declining because we're expecting to sell less. And when we're buying less product for inventory or direct for that matter, when we're selling less, buying less, we see our payables decline, right? So things are migrating from these other working capital accounts to cash. And then we turn it back around and we start seeing our receivables grow as our sales grow, our inventory grow as our sales grow, and our payables grow as our sales grow, right? So we end up going up in cash, then coming back down. So with the scenario that we've looked at here, certainly not the end of the world. These cash balances, of course, do take into consideration net profit losses and gains from the income statement, which, as we saw, were not big numbers, but that's not the end of what we need to be thinking about. Okay, so the last tab that's important here is the modeling tab. So what we do is we've put together the ability to say what happens if fill in the blank. Okay, so we have the ability to look at what is our cash projected to be beginning and ending at a month, and then if we were to make some adjustments, right? If we were to change some expenses, or if we expect the market to have some influence on our business, for example, margins going up, margins going down, customers paying us in more days than historically they have, etc. We can account for those dynamics on this tab. So we start with our balances from the previous page, and then we go, okay, let's look at potentially what happens if our margins change. What happens if we decide that we want to really try and reduce some expenses, okay? And lastly, we'll look at in a second, what happens if our receivables expand or contract and our payables change or our inventory changes? What's the impact that that's going to have on our cash? So what I'll do is I'll just play with this for a second. So if we were to say in May, we expect, because there's going to be, we're in a market where people are carrying a lot of inventory, demand has really dropped off, people are going to try to move that inventory, convert it to cash, so there's going to be a margin decline. Okay, so in that case, we would enter, let's just say 50 basis points. We expect the margin to decline in May, and then we expect another 50 basis point decline in June. What you see is that generates negative cash. And that's gonna hurt our cash. Makes a lot of sense. Want to point out here that the expenses, the items from the income statement, those will carry forward, right? So we're going to see that the loss of 50 basis points here and 50 basis points here. So for all practical purposes, our margin going from 22 to 21, that's going to perpetuate and that's going to continue. And if we think that things will come back and we'll get that 100 basis points back here, what you'll see is now we're back to square one, and there's no impact on our cash, right? But in the interim, we did burn some cash here from that margin decline. Exact same functionality here, except it's dollars. So if I think that I'm going to make some changes to my sales expense, and I'm going to reduce it by $1, you can see here, use that dollar reduction. Actually, it's an expense, so we enter 1 there, so it's going to. I did it right the first time. You're going to see it's 1. So by reducing the $1 in cash in expenses for selling expense, you see that adjust our cash positively. Throughout the period here. Below that out here, so it's consistent. So you can model changes to your expense base here. If we're going to terminate leases, we're going to change our headcount, other things. So that's one piece margin, 2 piece expenses. Now I'm going to spend a second looking at the working capital accounts here. So we've got our accounts receivable, our accounts payable, and our inventory. Currently, we're getting paid in about 45.6 days from our customers. We're paying our suppliers in 25.9 days, and we're carrying about 50 days worth of inventory. If you recall, the decline that we projected on the pro forma P&L was relatively subtle. It was something it was certainly not catastrophic. Certainly something we've been through in prior recessions. However, we shouldn't just say, okay, we're in good shape. Let's just sleep well at night, because there's a lot of disruption out there. So let me show you what happens if all of a sudden our customers start stringing us out and paying us in 5 days more and 5 days more, and we go from 45 days to 60 days because our receivables go out 5 days each in May, June, and July. So number one, those are one-time hits. Those, unlike income statement items, are not going to carry forward. They're going to be one-time hits, right? But here's what's scary: is if that were to happen, then you can see we take a cash hit here, but look, all of a sudden, whereas previously we were looking cash was not going to be a problem. All of a sudden, if our customers start paying us in eventually 60 days instead of 45, we have found ourselves, when we start trying to grow again and needing capital to invest in receivables and inventory and paying our vendors, we are in a cash crunch. Okay, so receivable days here, if we wanted to pull in receivables, excuse me, then we could enter a negative amount there, right? If all of a sudden we're going to try and get rid of some inventory, and we're going to go from 50 days worth of inventory, and we're going to bring that down 10 days, well, that's going to free up $31 in cash. And so we see that here, and we see that gives us a nice cushion for going forward. That's a big decision a lot of companies are going to have to make, is coming out of a downturn, generally having inventory is a good thing. Especially, I think, in the situation we're in now, where there's a lot of supply chain disruption going on. It's probably a somewhat dicey assumption for some businesses to go, when I want to buy again, I can buy, and the lead times aren't going to be any different than they have been. Okay, some companies might say, I want to have as much inventory as I can when things turn around, but of course, I don't want to have so much inventory that I don't have any cash, and create a whole nother set of problems with us here. So this is the modeling tab that built on the historical information we built, the sales trend that we entered in on the pro forma tab, the working capital accounts that we enter on the cash tab, and we can play through a bunch of what if scenarios. Okay. The other thing I just want to spend a little time on here is we looked at a gentle downturn, and as I mentioned, I suggest that we don't just put in what's our best guess, but let's put in some parameters. Let's put in a realistic scenario. Let's put in a worst case scenario. So here, same historical baseline. Okay, we drop off and we don't go down to 75%. We go down to 20%. We stay there for a while, and things don't come back until the year's over. Okay, in that situation, we see a lot bigger losses here, and we see that we actually, we're going to run out of cash in that situation. We're going to run out of cash, not at the bottom, right? When things are the worst, that's when we're going to be flush with cash. Considering we started with 10, and we're going to be close to $100 here because our receivables are going to be microscopic. We're going to have a lot less inventory, and we're going to be paying our vendors not $80 but $16. It's when we start growing that we start seeing the pressure put on cash, and that's the old saying: it's not the fall that kills you, it's the stopping. When we need to redeploy cash is when we realize we don't have as much. So this potentially is what a catastrophic, or catastrophic is probably a little too strong, but a more severe downturn would look like. This might be a little too pessimistic, but that is kind of the mindset, because the sooner that you can identify a potential issue, the sooner you can react, the better. Okay, because as we indicated here, if we want to try and save some cash, if we make a reduction here, so we reduced it by 1. We've just by acting early and getting that benefit for the whole period, we've almost negated the cash issue, right? I mean, we've pushed the whole thing out 1 month. By making a choice here, if we wait to make that to here, when we're truly kind of bottoming out, the impact's going to be much less, right? Because we've lost the potential benefit of these months by making the decision earlier. So understanding what decisions are going to be made, or what are the options if this scenario starts manifesting itself, knowing what you're going to do instead of making it in the heat of battle, if you will, is going to be much more beneficial. So that's really what I wanted to cover in terms of how this tool works, how we would suggest that you use it. Of course, any questions, please feel free to email or get in touch with me otherwise, and I'll be happy to talk about it. So good luck, stay well, and see you on the other side.